Recession. We are hearing the dreaded word once again quite frequently these days. The last time we remember hearing about this was back in 2008. What we remember of it, that it had led to the biggest financial institutions going bust, economies facing the brunt, stock markets crashing, and jobs being lost. This time, there is a fear that the developed economies, the US and Europe, may actually slip into recession on the back of the Russia-Ukraine war, the skyrocketing inflation, the steep hike in interest rates. But what exactly is recession? And how do we know if an economy is in a recession? So let's dive right in to understand everything that you should know about recession. Now, while there is no official or a globally recognized definition of recession, in 1974, the US economist Julius Chiskin described recession as 2 consecutive quarters of contracting growth. And many countries, even today, adhere to that. And this definition is widely recognized as a technical recession. Now, as per this definition, India entered a recession in 2020 as well, with the GDP contracting from April to June quarter and then from July to September as well. But soon we saw the return of growth in positive territory on the back of huge demand, and therefore many experts believe that looking at wider range of indicators is important to define recession. See, when a nation's economy experiences negative GDP, the rising levels of unemployment, the falling retail sales and contracting measures of income and manufacturing for an extended period of time. The US National Bureau of Economic Research, or NBER, also defines recession as a significant decline in economic activity spread across the economy and lasting more than a few months or even years. Simply put, a recession is when the economy stops growing and starts shrinking. So what causes a recession? Well, there is more than one way for a recession to really start. It could start from a sudden economic shock. Now, the coronavirus outbreak, which actually shut down all the economies worldwide, is the most recent example of a sudden economic shock. Now, excessive debt could also lead to a recession. See, when individuals or businesses or governments take too much debt, the cost of servicing the debt can actually grow to the point when they cannot pay their bills. The housing bubble, for instance, as well, led to the Great Recession from 2007 to 2009 and is a prime example of excessive debt causing recession. Next could be asset bubbles. An example of this was the dot-com bubble from 1995 to 2000, when the internet-based companies and those stocks on the Nasdaq experienced exponential growth of over 400%. However, the bubble burst in 2002 and the stock prices fell to around 78%. Most companies did not survive that crash, and the whole US economy was heavily affected by it, causing a mild recession. Now, too much inflation could be another reason. Inflation isn't a bad thing per se, but the excessive inflation is dangerous, as central banks then control inflation by raising the interest rates, and higher interest rates depress economic activity. And this exactly is the big worry currently, and this is exactly why some people believe that a recession may be coming. The short answer to this one would be the Federal Reserve. The US Central Bank is trying to slow the economy down in order to curb inflation, which is now rising at its fastest pace since 1981. Last week, the Fed announced its biggest interest rate increase since 1994, and more big jumps on borrowing costs are likely this year. Experts are getting worried that these steep rate hikes may actually set off recession, as initial signs are already giving some indications of that. Like the US stock markets have entered a bear phase. They are 20% down from their all-time highs. And not just the US, even Europe is staring at a recession. The short supply of gas in Europe due to the Russia-Ukraine war, experts say, may actually trigger recession in Europe. So how long do recessions really last? Well, on an average, recessions since World War II have lasted over 10 months, according to NBER. But of course, there are some stand out. The Great Depression, which is seared in the memories of the older Americans, began in 1929, ended only 4 years later. The Great Recession lasted for about 18 months after starting in the late 2007. The recession at the height of the COVID-19 pandemic in 2020 went on for just 2 months, making it the shortest ever. So how do recessions impact you and me? Well, quite often we have seen unemployment levels rise during a recession. Investments in stocks, in bonds, in real estate and other asset classes lose money in a recession. Also, business owners make fewer sales during a recession and may even be forced into bankruptcy. And there are other macro implications for the economy as well. So, should you be concerned about a recession? Well, experts say that downturns are actually a normal part of an economic cycle or a business cycle. So, there is no need to really worry just yet, but you should always be prepared. Make sure that your debts are paid. Cut back on spending, begin saving and investing more. Have an emergency fund prepared for the worst times, and you will be all right.
If you like the video, do like, comment, share and subscribe.